sense of people wanting to belong, to be connected, to have freedom. And I think the younger generation speaking about disability pride is going to be our greatest game changer. I am proud to be a
You've just noticed cold air coming in from a couple windows, or that your patio door isn't closing fully, which means you're losing heat in the winter, losing cooling in the summer, losing money all year long. And that means now is the time for new windows and patio doors from Renewal by Andersen. Most installations are usually done in just one day. Renewal by Andersen windows and doors can help lower your heating bills and air conditioning bills with their most energy efficient glass available. Only their windows are made with Fibrex material, proven to be 2 times stronger than vinyl. And they're backed by a 20-year warranty. And right now, when you buy one window or door, get one at 40% off. Plus, there's no money down, no payments for 12 months, and no interest for 12 months. So call right now.
1-800-203-7194. 1-800-203-7194.
When selling your home, one wrong move can cost you thousands of dollars. You need a top real estate agent who will do things right. Sell your home fast and at a great price. Introducing HomeLight, the breakthrough way to sell your home. HomeLight has detailed stats on the top real estate agents and home sales in your neighborhood. Nearly 1 million people have used HomeLight to find experienced agents they can trust to sell their homes faster and for more money. Start for free at HomeLight.com.
Having trouble getting help for erectile dysfunction? Get help fast with Lemonade Health. Just answer a few questions. And they can send you medication so you can get better quickly. Visit lemonadehealth.com today.
Commit to energy. Focus on innovation. Discover the next growth opportunities. Climate technology. All you need to know to invest in the future. The ultimate source. CNBC.com/climate. The CNBC app has new features just for you. With real-time market data, create custom watch lists, get stock quotes, and get your own personalized alerts. Keep up with top videos, get the latest podcasts. And now you can watch CNBC live with a daily free preview.
Let's just say it's your opportunity.
The CNBC app. Download it today.
You're watching the second hour of Squawk Box. The headlines: Wall Street rallies from its Omicron sell-off, with the Dow jumping more than 600 points, while futures are cautious ahead of today's jobs report. Crude prices gain as OPEC Plus producers consider cutting supplies ahead of schedule if the Omicron variant dents demand, but they've currently stuck to plans to add 400,000 barrels a day next month.
Chinese ride-hailing company Didi announces plans to delist from the New York Stock Exchange and go on to list in Hong Kong amid Beijing's regulatory crackdown, while rival Grab sinks 20% in its US debut. US regulators sue to block the sale of ARM to NVIDIA, citing competition concerns around the largest semiconductor chip merger in history.
And the EU says Omicron will become the dominant COVID infection driver in Europe over coming months. The scores test positive for the variant at a Christmas party in Oslo, and Germany seeks compulsory jabs.
A general vaccination mandate should be decided by the Parliament. We have asked the Ethics Commission to work on a recommendation, and the general vaccination mandate could start in February 2022.
Ladies and gentlemen, a very warm welcome to the second hour of Squawk Box. us in the media, us pundits, us commentators, very often will hype up a story that, quite frankly, we're interested in, but you might think, it's not that big a deal. Well, I tell you a story that needs no hyping whatsoever. And I'm just going to let these numbers speak because they are absolutely extraordinary. I'm talking about Turkey. I'm talking about economic policy, which seems unconventional at best. It seems stunningly politically driven. Let's be brutally frank about it. And I'm going to tell you some data now as well. We worry about inflation, of course, in the West and whether 4% is a problem or not. We'll have a look at the Turkish figures here. Now, I've built it up. This will be big, I can assure you. Right. So the November CPI was up 1 month, 3.5% month on month, compared with the official forecast of 3%, or the poll forecast of 3%. That has transpired now to a figure, bearing in mind we've been talking about nearly 20% inflation in Turkey up till now. Well, we don't have to say nearly 20% anymore. It is significantly over 20%. We're talking about 21.3% year on year. Turkish inflation, with the interest rates being cut and a new finance minister in place, and the much respected man booted out of his job previously, or resigned apparently, and now we have a new loyalist finance minister as of yesterday. We now have 21.3% inflation rate on a CPI measure over in Turkey as well. Would you like to know the PPI data, i.e. the wholesale producer number in Turkey? It's extraordinary. It is up 10%, give or take the decimal, in November. It is up on an annualized basis. This is wholesale costs over in Turkey, where interest rates have been cut, to 54.62%. There are times, Jeff and Karen, when, as I say, we're interested in big numbers, but quite frankly, our viewers are like, I'm not quite sure why that's so significant. Well, I think these are stunningly large figures. Let me just now switch to the Turkish Lira, which is, quite frankly, there or thereabouts on its lows versus the dollar and the euro as well. We're now hitting 13.7, up 7/10 on the day, up at 13.7 versus the dollar. But I mean, we're talking about stunning, I beg pardon, down 13 point, trading at 13.7, down 0.7 of 1% versus the dollar. You know what I'm saying? So we've had this enormous decline in the Turkish lira there. And against the euro, it is trading flat. So I think a lot of people are expecting some pretty horrible numbers as well. But you've now got a new finance minister, you've got a pretty compliant central bank as well, and you've got 54% wholesale price inflation and 21% CPI. Let's just hope there's no contagion there. Hey, Jeff, Karen?
Yeah, absolutely, Steve. And of course, it's a salient reminder that your negative yield is just increasing. So ultimately, inflation is eating away at your income. It's eating away at your assets. The decline in the lira is reducing the international value of whatever you own. And it's eating away at your profits if you're a corporate. So there are a lot of reasons to be unhappy about the job that inflation plays in making you poorer, sometimes very slowly, but in this case, increasingly more quickly. And of course, the decision tree that President Erdogan is using at the moment is not one that classical economic students understand.
It wasn't in any of the economics books that I studied, I've got to say. And I would also guess that this is not transitory. If you look at the pricing pressures over the course of many, many years, if you just take stock of what are the most important elements in the CPI basket in Turkey, it's food, non-alcoholic beverages. So we're talking about staples here: housing, water, electricity, gas and other fuels, transportation. So it does tell you how this has a genuine impact on those living in Turkey on a day-to-day basis.
Let's move on. Let's talk about the jobs outlook in the United States. Initial jobless claims rose slightly to 222,000 last week. The figure was lower than economists expected. It's higher than the previous week's 194,000, the lowest figure since 1969. Continuing claims dropped below 2 million for the first time since March 2020 in the early days of the pandemic. The weekly figures imply a robust recovery in the US labor market. But we will find out more on that later today with the release of the highly anticipated monthly non-farm payrolls report. Economists expect payrolls to continue to have grown, with unemployment falling to 4.5% from 4.6% in October. Wage growth is also expected to accelerate slightly, supporting the Fed's case for tighter monetary conditions.
It's part of the puzzle, isn't it? Piece of the puzzle as we talk about whether we're going to see more accelerated plans, with the Fed already talking about this meeting in December where they will consider the taper program. So what we've got on futures, fairly cautious approach on the back of a very strong session on Wall Street yesterday. It was a bounce to the upside in what has been an incredibly volatile week. And you can see perhaps some of the steam just coming out of markets on the back of that buying. And let me just show you what it looked like in session. The Dow, 1.8+% pop, 600 points to the upside, strong for the SP500, a little bit less on the NASDAQ. And this can be explained by the big bounce we saw in the banking space. It had been fairly cautious around the bank names, despite the fact that Powell was parking the use of the word transitory, suggesting a more hawkish approach from the central bank, typically a sign that investors pile into banks as they start repricing those margins. But there's been a lot of caution too around the variant, given we're waiting enough for answers from scientists about the impact of Omicron on vaccines that have already been distributed. So markets a little bit cautious going into that Friday trade over the course of the week. We did have fairly big moves to the downside, but some that was trimmed yesterday, and currently we're down about 0.75% on the Dow for the trading week. But it is part of a broader trend we have seen continue to fall in the market since really about the start of November, several weeks of declines, and also a give back trade too on the NASDAQ. I want to take you treasuries because bond markets have been repricing around the Fed commentary, around the change in language around inflation. We've seen the short end yields move a little bit higher, about 10 basis points higher over the course of the week, a little bit less to the downside on the 10 and the 30-year, but it has meant we've had somewhat of a flattening of the yield curve in reaction to what Powell has been communicating here. But I think the dollar trade is one worth looking at because as we talk about interest rate differentials, we've still got the Fed front and center here, and that has meant a stronger dollar story. So sterling euro on the back foot, morning session here Friday. Dollars also gaining versus the safe haven Japanese yen, but a little bit weaker versus the Chinese currency. But I know that you are closely looking at some spending patterns, Jeff, and we've just come off the back of what has been the start of the key holiday spending period in the United States.
Yeah, well, there are two things that we have a lack of clarity about at the moment, it seems to me, that the market is fixated on. And one, of course, is what's happening with this latest COVID variant. And the other one, of course, is what is the real path for interest rates and tapering from the Federal Reserve at the moment. Because Jay Powell, once his nomination was confirmed, it seems to me, has switched tack on the tone, at least, of what's going to happen with tapering and interest rates from here on in. So I think all we can do is go back to the data and keep watching the data and what is the data saying about the resilience of this US economy. And so far, the jobs data seems to be confirming that the rebound is intact at the moment. And Bank of America put out some terrific numbers overnight on Black Friday credit card spending. And the credit card spending numbers show a 16.5% jump over a two-year period for 7 days ending November 27th. So this is card data that is focused around the Thanksgiving holiday and, of course, running up to the Black Friday spending. And in terms of what they saw, online retail spending as a share of total card spending also jumped quite significantly, up 22%, in spite of the fact that I think a lot of the bricks and mortar retailers were also able to report that they saw more footfall in store. So I think the underlying retail trends do look encouraging as well for those who are trying to get information on how confident Americans are about going out and spending whatever COVID windfall they managed to get over the last 18 months or so. And we do know, we were talking about this earlier in the week, that some of the confidence data from the Conference Board has weakened slightly. And that, you would suggest, means Americans are becoming a little more concerned about the outlook for their income and for their employment safety. But the spending data suggests something different here. So maybe when people phone them up and say, how confident are you feeling about they give one answer, and then they go on the website and start spending money.
You've got to get into the weeds in economic theory here. And if you think about what inflation typically means. That people spend more. They try and buy products or services quickly because they're concerned prices are going up. Is that really what we've got right now? If you look at the spending patterns, it feels as though people just didn't make purchases, couldn't get their hands on the right product before because of COVID challenges in the supply chain. They weren't doing certain things like going out, so they didn't need certain products to wear to go out, for instance. And one example of that. So have we really got the same patterns here? We may have rising prices. We don't actually have the same motivation, it seems, around typical inflation. Prices are going up because people are buying, but not because they think that prices are going up because they need to quickly acquire. If anything, I think if you think about the motivation, I mean, look at the car market. It's almost worth holding out because we think car prices are going to come down at some point, don't we? Particularly as new technology comes to the market and there's going to be more availability. And the second-hand market, we know that's not normal. We think that market may fall too. So if anything, it's worth waiting because you think prices are going to fall at some point. That's not a typical description of inflation, is it? Steve?
I would go with you on part on that, Karen. I don't actually think there are many products out there like the automobile industry as well. And I hear what you're saying, and it's indisputable that you're right, by the way. The extraordinary gains we've seen in the used car market is a product of the new car market, and we think at some stage that supply chains will improve and actually have a negative effect on both. But which is spot on, but I don't think we see that in many other things. I think expectations on wages is very interesting as well. And of course, then we dust off our thoughts about the Phillips curve as well. But if I may just go back to the jobs data we're expecting today, and it is only one snapshot of the broader market. And I think a lot of the economists out there are just desperate to see an improvement in the participation rate, which has been held down for various reasons, whether it's because of childcare, was it COVID concerns, whether it's something else going on there as well, such as I don't know, people just don't want to get back because they feel more economic wealthy, which comes back to Jeff's original point. But there is one stat out there which I haven't mentioned much, but it's part of the JOLTS data. And I think this is a really interesting stat. And that is the fact that the ratio of available workers to job openings fell to a record low last month, middle of the month, to 0.7. Basically, that means there are more openings than workers to fill them. Now, think about that. This is a record low. It's not the lowest since. It's not the lowest since the turn of the century, or 91 or 69, as we saw with last week's weekly jobless claims. This is the lowest figure ever, that ratio figure as well. And how do you alleviate that when at the same time, and this is extraordinary, more Americans are quitting their jobs than ever before? Again, so we're not talking about lowest since. We're talking about 4.4 million Americans felt that they could quit their jobs last month as well, in October actually, and add to the fact that you've got the lowest ratio of workers compared with openings in history in America. That says to me that there are stunningly large tensions, and they're not just about Omicron, they're not just about COVID. There are longer term issues there as well, which are going to take a very long while to shake through the system.
We're going to wrap it up at that point. Non-farm payrolls then out later on the day. We will talk some more about that as we go through the programme, and we will keep an eye on the futures as well, just to see how they adjust as we approach the start of the US session. DD announces it'll delist from the US and move its shares to Asia amid increased regulatory pressure. We'll have the latest when we come back.
Now get greedy whenever you want. Subscribe to the American Greed Podcast and take your greed to go.
Crime absolutely pays, and it pays a lot.
Some people will do anything for money.
Nuts.com has something for everyone to love. Incredible nuts, dried fruits, organic snacks, and gluten-free treats. Plus, free shipping with your first order.
Best pistachios ever.
Love the dried peaches.
White chocolate toffee cashews are awesome.
Check out Nuts.com.
Do you worry about going to the dentist? After all, a visit to the dentist can easily cost $2,000 or more. Well, relax. The Carefree dental card is now available in your area. Call now and we'll send your actual card at no cost today. With the Carefree dental card, you go to the dentist whenever you need and you instantly pay a lot less. Activate your card and you can start using it immediately. From exams and cleanings to more expensive procedures like crowns, dentures, even braces, they're all included with the Carefree dental card. Say you go to the dentist today without any card and your bill is, well, ouch. Wait a minute, let's try that again. You go to the dentist today and show your Carefree dental card, you save $525. The Carefree dental card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-997-2117 to receive your free Carefree dental card information kit. Call 1-800-997-2117 now.
Is your business struggling to keep up with the big guys? Now, with peoplesmart.com, you have the same prospecting tools they do. Enter a name and title to search for detailed contact info on quality decision makers. Peoplesmart.com, the smarter way to prospect.
The American spirit. Inherently competitive. Always driven with an appetite to succeed. Perseverance is paramount. Knowledge, essential.
Good morning, everybody. Welcome to Squawk Box here on CNBC.
That's what drives us. It's in our DNA to provide the information you need to propel your dreams forward. Tune in for Tech Check. Zero in on opportunities.
Where are all of these batteries going to come from?
Red hot startups.
It is one of this year's most anticipated IPOs.
From the East Coast.
We are watching some of the key players in the alternative energy space.
And the West Coast.
So many new streaming rivals.
The go-to destination for investors. Driving the future. Tech Check. Weekdays, 11 a.m. Eastern, 8 a.m. Pacific. CNBC.
Right, there's a lot going on in corporate news as well. The largest semiconductor chip merger in history is now in jeopardy, with US regulators moving to block NVIDIA's planned acquisition of the British chip firm ARM. The Federal Trade Commission cited antitrust concerns, saying the proposed deal would give NVIDIA control of computing technology that its competitors rely on. Now, the FTC move comes a month after British regulators said they would launch a similar in-depth probe of the deal. Shares of NVIDIA closed 2% higher. Let's move on to Southeast Asia's super app, which is Grub. It skidded in Wall Street debut. The ride-hailing and delivery company opened 19% higher, and then it reversed course. It was the biggest US listing for a Southeast Asian firm, following a record-breaking $40 billion SPAC merger with Altimeter Group, Growth Corp, I should say. Right, okay, the ride-hailing giant is still posting losses. How does that work? But CEO Anthony Tan told CNBC he's confident about the company's path to profitability.
We don't view growth and profitability as mutually exclusive, Andrew. We operate in a market with a large market opportunity and low penetration across our verticals. So you just look at food penetration is 12% in Southeast Asia versus 21% in China. Mobility is 3% in this region versus 12% in China. And we've been able to build a great track record of achieving significant top-line growth while taking massive steps towards profitability. So our mobility margins, for example, 12% as of Q3 2021. These are industry leading and have been relatively stable for several quarters. Our deliveries is only a 3-year-old business, but already break even in a majority of our markets. And we'll apply a similar approach to cost optimization to deliveries as we have done in mobility. So we do believe we have a cost leadership advantage, as I talked about, as a super app. And more importantly, we're offering an ecosystem of highly complementary services that address high frequency, everyday needs all through one app. So we're scaling and we're growing and investing in this growth while making sure we're exercising cost discipline. So I'm confident we have this clear path to profitability because of the super app model.
And what's that timing look like to you?
Well, we're just going to keep executing upon this long-term strategy. And we're seeing, as I shared, mobility margins are strong. We're seeing in our deliveries business break even just after 3 years in majority of our markets.
Anthony Tan from Grab. Chinese ride-hailing giant Didi says it'll delist from the New York Stock Exchange and move to Hong Kong instead. Shares plunged last week amid reports Chinese regulators were pressuring executives to delist from the United States over data security concerns. Foreign public companies listed in the US may be delisted if their auditors don't comply with information requests, according to a new rule adopted by the US SEC. The amendment passed in 2020 after Chinese regulators repeatedly denied audit requests. The SEC will now be able to ban companies from trading and delist them if audit requests are evaded for 3 years. Now, very interesting how this story is being presented in different parts of the world. I think what we've done here is we've given you a very neutral read. The Chinese regulators are saying you cannot hand over this data in the United States because it is about Chinese users of this company's services, and we don't want US authorities to have it. From the SEC perspective, the SEC is saying, we don't always understand who are the beneficial owners of the businesses, how this company is run, where the profits go, how it's managed. We need more information. We need a proper audit of the business back in China, perhaps where most of its services are provided. If you read the South China Morning Post, DD is one of a number of Chinese companies that may be, in inverted commas, kicked off the US exchanges because of these new regulations that the SEC is putting in place. But it seems to me that DD is proactively thinking about and planning to shift its IPO domicile to the United States, its share listing, from the United States to Hong Kong, because we know that Beijing is taking a much more aggressive attitude towards regulation of Chinese companies. And data, as we've seen from the way the Chinese government has behaved around Ant Financial and its information on Chinese consumers, the Chinese government has decided enough is enough. This data belongs to the state. It doesn't belong to private companies, and we are concerned about how it gets used here. So my first point would be there's a bit of a blame game going on here. And I think it does a disservice to the broader investment community that just wants clarity, and to the companies themselves who want deep trading markets with good liquidity. And I think we do need some clarity on this picture, because right now, if you look at measures of Chinese technology stock losses, effectively the market capitalization of this sector is at least $1.5 trillion lower than it was before we saw the Chinese regulatory crackdown start. And if now these companies are going to lose the opportunity of those deep liquid pools of investors provided in the United States listings, then I think maybe we're going to see those market capitalizations fall even further from here.
It's been an incredible journey, hasn't it? First up, whether these companies are welcome in the United States under the Trump era, to whether these companies want to be listed in the United States from the Chinese perspective. So you've seen a huge change in dialogue. And don't forget, for many American investors, they were fixated on the Chinese consumer story. They very much wanted to play in such a large market to have access to that growth story. And the fact that these companies came to the United States to list gave them a very easy way to tap into that Chinese consumer. So if they delist and they move back to China markets, and don't forget, mandates are quite different for some American companies, American investors, whether they can even continue to invest in these Chinese markets with the lack of scrutiny that they may have on some of the books as well. That could be a potential problem. So I think we have seen an incredible change in the narrative. And you may recall in recent weeks with this crackdown, some US investors have already been saying, well, these companies are just uninvestable now. We are really concerned about the direction that Chinese regulators have had. We don't think you can touch any of these names, but whether they want to or not may be taken away from them now if you see these companies revert back to solely Chinese or Hong Kong listings.
Which takes us back to, I think, where we started the week with Andrew Ross Sorkin talking to Ray Dalio. And Ray Dalio said, oh, yeah, there are a few kind of missteps, but ultimately we think China is a good place to invest. And we know he's been actively raising funds to do that at this point. But as you've pointed out, there are plenty on the other side in this story who are saying there is an uncertain regulatory outlook for many sectors now in the Chinese economy. And the government can do a handbrake turn at any moment. and you lose your shirt as a consequence of that. So I think it's just worth bearing in mind as you listen to some of these giants of the investment world, not everybody agrees with the conclusions that they're coming to.
There are policy implications here too, as we talk about the role of technology and how policymakers should consider their significance in society. And don't forget, we thought about that through the lens of some of the big delivery apps here in the UK during the pandemic. We just thought they were, built out new tech platforms and they were chasing growth and loss making, and we didn't really need to think about them from a national security perspective. But they became very integral in feeding populations when we saw lockdowns and restrictions around coronavirus. And I think that does tell you a broader story as we see more and more technology platforms building out and having relevance across society, that regulators are going to take another look at national security implications, not to mention the data, of course, that is coming through these platforms and how it's managed. There's a huge trust issue there. China, a very different approach to a lot of Western markets around that use of data as well. So I think perhaps the Chinese might be on the front foot here in terms of thinking about national significance of technology companies in future.
Interesting you point out food delivery companies. Jim Chanos has gone short against DoorDash. Maybe we'll talk about that a little later on in the program. But for more on Didi and how it's impacting investors, SoftBank, you can go to our website. That's cnbc.com.
We are counting you down to the start of the Friday trade. It's been quite a week, hasn't it? Very wild ride on some of these markets. And we are now perched to the upside today after falls across European markets yesterday. So perhaps we'll play catch up to that Wall Street trade yesterday as we chase a little bit of a firmer trade this morning.
Had either of you ever invented anything before?
Nothing.
We went from 5 employees to 500.
Stream Success with Jay Wells. Subscribe to the podcast now.
Orcam My Eye continues to enable me to live the life that I had once lived before when I did have eyesight. I came face to face with a suicide car bomb. And once I really understood that I would never be able to see again, it was beyond devastating.
It's often the small things in our life that make the greatest impact. Technology such as the Orcam is what has blessed our life.
Pumpkin spice cereal.
Oh yeah. Orcam My Eye is great for any eyesight loss.
Then he climbed up the tree.
And once I received the Orcam My Eye, it enabled me to read for them before they went to bed.
Orcam changed my life. It gave me an opportunity to have a break. I was able to go read a book myself.
Orcam, empowering people who are blind or visually impaired to live more independently. Call now, 800-718-5743.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on the planet on a daily basis.
It's more entertaining than any other morning show, but you actually might get some useful information.
The issue is privacy of consumer data.
This is really cool.
For me, Squawk Box is breakfast with the most interesting people in the world. You're the best thing in the morning. How's that?
It's a privilege to get to talk to them every day.
Squawk Box, weekday mornings, 6 Eastern. CNBC. The American spirit, inherently competitive, always driven with a hunger, ambition, and an appetite to succeed. The pursuit of prosperity can be unpredictable and thrilling. From breakthroughs to breakdowns, the launches and the crashes. Perseverance is paramount. Knowledge essential.
Good morning, everybody. Welcome to Squawk Box here on CNBC.
That's what drives us. It's in our DNA to provide the information you need wherever you are to propel your dreams forward.
Welcome to Squawk Box. If you are just joining us, here are your headlines today. European futures rise after Wall Street recovers ahead of today's jobs data, while oil prices stay in the green as OPEC Plus keeps cautious over Omicron. Turkish inflation spikes to over 20% in November amid the lira's historic declines, while producer prices skyrocket almost 55%. Chinese ride-hailing company Didi announces plans to delist from the New York Stock Exchange and list in Hong Kong amid Beijing's regulatory crackdown. Meanwhile, rival Grab sinks 20% in its US debut. And US regulators sue to block the sale of ARM to NVIDIA, citing competition concerns around the largest semiconductor chip merger in history. US markets giving us a nice lead yesterday. Very strong signals on the Dow, the S&P and NASDAQ. Japanese stocks picking up on that and bouncing ahead through the 28,000 point mark. Solid 1% added across on the Chinese market. Also in the green, but Hong Kong just flashing up in the red. But don't forget, we did have a contrasting picture yesterday where the market was supported as we saw news around property developers tapping the market. Key area of concern. And don't forget Didi, another big issue today too. The news that it plans to delist from the States and relist in Hong Kong. That's a big issue for some investors chasing the technology story. I want to show you what's playing out in Europe early on. We are setting up for a much firmer day of trade. 0.7% on some of the markets from Germany to France, a bit less on FTSE futures. It does come on the back of what was a weak trading session yesterday, which left us out of lockstep with the US markets where we saw that green. So we traded down about 1.1% on the Stoxx Europe 600, a little bit more on some of the individual markets. So we're looking to claw back some of that ground first up in trade today. US futures, though, are not giving us the most confident of pictures, but don't forget we are waiting it out for a key data point, the non-farm payrolls report. We've had a slightly more hawkish tilt to the Fed as Jay Powell's been talking about retiring the use of the word transitory this week, despite huge uncertainty still around the latest variant. And the market has been taking stock of that. But at this stage, you can see we are a little bit mixed on these numbers as we count down to the trade. Jobs report, though, could be instrumental to how the rest of the day plays out. Steve.
Indeed it will, Karen. Yeah, thank you very much indeed for that. Just looking at the Turkish Lira, losing back a little bit more ground. Okay, right. The French moderate conservative candidate Valérie Pécresse will go into a runoff against right-wing Éric Ciotti to lead Les Républicains in the presidential election next year. The surprise result pushes the former EU negotiator Michel Barnier and the ex-health minister Xavier Bertrand out of the race. So that was it. So despite his lurch to becoming more nationalistic and perhaps less pro-EU, didn't quite work for Barnier there, which is quite interesting, isn't it? In the meantime, the US Secretary of State, Antony Blinken, says it's Russia's responsibility to de-escalate tensions with Ukraine. He met with the Russian counterpart Sergei Lavrov amid growing concern over Moscow's presence on the border with Ukraine. Both parties hinted that a meeting between their presidents may happen soon. The US Secretary of State, though, said both countries would be supported to diplomatically work their way through the conflict.
I made very clear our deep concerns and our resolve to hold Russia responsible for its actions, including our commitment to work with European allies to impose severe costs and consequences on Russia if it takes further aggressive action against Ukraine. And as with Foreign Minister Kuleba, I also made clear the United States is prepared to work with both parties to support a diplomatic resolution through implementation of the Minsk agreements in any way that we can. That diplomatic way forward can avert a crisis that would serve no one's interests. Foreign Minister Lavrov and I had candid exchanges on our different perspectives. We agreed to report those back to our presidents, who may have the opportunity to speak directly in the near future.
Antony Blinken there. Turkish inflation rose more than expected in November to 21.3%. That is the highest level in 3 years, but the spike in producer price inflation was even more pronounced, coming in at over 54% annually. The Turkish Lira, as you can see here, has weakened further on the back of that number. Kevin Daly joins us, co-head of economics at Goldman Sachs for the CEEMEA region. Kevin, good to have you with us. Just walk us through this. Obviously, the latest inflation data is putting further pressure on the lira here. When does Turkey become investable, or is it now? You just have to be clever about where you put your money.
Well, I think we're yeah, we're some distance from that point. And the inflation data was actually, bear in mind, this is inflation data for November. And the sharp decline in the lira only began in mid-November. So the lira has fallen on a trade-weighted basis more than 25% since mid-November. So the last 2 weeks of November. So most of that impact really won't be seen until the December data. So bad as today's inflation data are, actually we're likely to see much worse next month. And this is creating, pretty dangerous cycle for the Turkish lira, in as much as, we have higher inflation is pushing real interest rates even more negative. So real interest rates currently around -5%. So, the more inflation rises, the further negative real interest rates go. That is further undermining domestic confidence in the lira. So there is a dangerous cycle here whereby higher inflation feeds further lira weakness, which feeds higher inflation. So, there is the situation in our view, we think is unsustainable at the moment.
Is there going to be then in the near future a very sharp reversal of current policy on interest rates? I mean, do you see that at all, given how President Erdogan seems to be stubbornly insisting that his understanding of interest rates and inflation is the right understanding?
Yeah, so I mean, he is constantly doubling down on this view. So it's certainly clear that there's no evidence as yet of a near-term change in policy direction. But it's our view, my colleagues' view, our team's view, that actually ultimately they will be forced to change direction. We expect that they've pretty clearly signaled that they want to cut rates again in December. We think they, given the ongoing rhetoric, they probably will do that. But we think they're going to have to reverse that course then pretty shortly thereafter. So, we expect our forecast implies that interest rates will rise by 6 percentage points next year.
Then, as we look at Turkey, is this going to be an isolated story, or are we seeing any evidence of contagion?
So it's an interesting, because this is very much a domestic story. I mean, you talked in the introduction about how Turkey has become uninvestable. I wouldn't quite put it that strongly, but what is the case is that foreign involvement in the Turkish market is now being relatively limited, has been relatively limited for some time. So, for that reason, we think this is, very much an isolated picture. There are certainly other challenges that other EM economies are facing, but the contagion effects now from Turkey to other markets are much less than they have been in the past. And it really is the domestic dynamic. So it's Turkish nationals themselves losing confidence in their currency, which is fueling this decline in the lira.
So, Kevin, what does that mean in terms of getting movements back into dollar versus lira? If you do get any change in policy or an improvement in the narrative, do you start to see wild swings then to the opposite direction in the lira on the back of any change in policy?
Also, as I say, there seems to be some distance from changing policy at the moment, but our central case is still that ultimately they will follow a more orthodox route. They will raise interest rates again, but there are alternatives. One alternative, less orthodox alternative, would be to for the administration to introduce essentially quasi capital control, so administrative measures to try and prevent Turkish lira leakage. That would be a negative outcome clearly for Turkey and for the market. Another possibility, which would be in the short run would seem much more attractive to the Turkish authorities, would be to try and attract additional funding, perhaps from some of their neighbours in the Middle East. But in our view is that the issue is not short-term funding pressures. The issue is more that real interest rates are significantly too low at -5%, and unless they address that, any additional help they may get from abroad will only be temporary in nature, and it really is a reversal in interest rates that they require.
About the relevance here for global markets, because we have a broader debate for central banks about not letting inflation run too hot and getting ahead of that narrative, even if we do have a very unusual situation with the pandemic that's pushed up prices. What's the relevance here? Do we see some transitory pricing pressures in Turkey, and will some of it fade out, or is it really just a job where we've already had inflation entrenched for so many years and they need to get ahead of it now?
No, it is. I mean, it's true that, you know, across the world, many central banks are dealing with, you know, both in the developed world, but also the emerging world, are dealing with high inflation rates. You know, that's true within CME, it's true across Central and Eastern Europe, it's true, you know, across Russia, for instance, as well. But the pressures that those central banks are facing are of, you know, a very small magnitude relative to what is happening with what is happening in Turkey, and the you know, very acute pressures that Turkey are facing are homegrown, and they're driven by inappropriate monetary policy. I mean, we talked about, you know, the 25% plus decline in the lira since mid-November, but bear in mind, over the course of this year, it's fallen more than 40%. So you know, this is causing inflation to rise already, you know, well above 20%, in our view, probably above 25%, and possibly, you know, closer to 30% potentially in December.
Kevin, you've talked a lot about the economics and contagion, and I appreciate that as well. But this is a political crisis, isn't it? When the politicians decide they know better than the economists about how to run an economy, and the president has new economic orthodoxy, should we say, as well. When will this only end when we have a change in the political setup in Turkey?
It's a challenge. You know, I'm reluctant to comment directly on Turkish politics in that way, but it certainly is. You know, one of the crucial problems that the monetary authorities faces the fact that their credibility has been entirely undermined by the frequent changes in administration, central bank governors. We saw the finance minister change yesterday. So, you know, clearly, yeah, political involvement in monetary policy and with very unorthodox views, I think it's fair to say, has, you know, been the main cause of the weakness of the lira. You know, we do see in other economies that politicians sometimes get excessively involved in monetary policy, but, you know, it is unique, I would say, to Turkey that with that political involvement comes such unconventional views. I mean, other politicians don't have this, should we say, pretty unique view that President Erdogan has, that lower interest rates cause lower inflation.
Kevin, when I look at the region, I see arguably 3 or 4 stunningly important players in the Middle East, and obviously in this area, and of course Iran, Saudi, and Israel, absolutely key. But I see Turkey up there as well as important regionally for stability. If you have 54% wholesale price inflation and political eruptions on the back of that, potentially in one of the most important NATO members in the region, and of course a group which has courted Russia at various times and of course has such regional influence, I think this is stunningly important from a political instability point of view. Now, whilst I appreciate that you're an economist and you look at it from a finance point of view, I have huge worries about what this means for the broader region. Do you not see a path where this could be a problem?
It is, no, I mean, that instability is a concern. Actually, it is interesting, the fact that Turkey is in a fragile economic state at the moment, actually, ironically, increases the pressure on it to reduce the political risk premium that the economy faces. So, you know, it needs, Turkey in its current economic state needs friends. And so it is possible. I agree with you entirely that, you know, the situation is very volatile and that volatility breeds risks, but it's possible that Turkey may actually seek greater support, and in, you know, one potential short-term solution, at least for Erdogan, is to try and reduce political risk by making, you know, potentially more, you know, favorable approach to, towards the US in particular, but also reaching out to its neighbors for potential financial support. As I've argued, I think that will only bring temporary reprieve, because the fundamental root of the problem is that real interest rates are too low. But actually, it does create incentives for them to be, a better neighbor.
Kevin, really appreciate it. It's just a fascinating conversation. So thank you so much indeed for bringing it to us. Kevin Daly, co-head of Senior Economics over at Goldman Sachs. We shall move on. Coming up on the show, the US braced itself for a tough winter as more states report cases of the Omicron variant. We'll bring you the latest after the break.
We put everything we had into this. Do not miss the chance to get in.
We had an opportunity. We took it.
My family is going to come in here and tackle you. Do this deal.
Shark Tank, Sunday through Thursday, starting 8 Eastern, CNBC.
Let freedom in. Freedom to work, freedom to play, freedom to simply be. Need a space to call your own? Four Seasons has got you covered no matter your style or budget. To ensure your well-being, our teams are temperature checked, wear gloves and masks, and maintain social distancing protocol. In support of hardworking Americans, take advantage of easy payments, and for a limited time only, call now and save up to 40%. With products that are American-made and American-inspired, it's time to let freedom in.
Orcam My Eye continues to enable me to live the life that I had once lived before when I did have eyesight. I came face to face with a suicide car bomb. And once I really understood that I would never be able to see again, it was beyond devastating.
It's often the small things in our life that make the greatest impact. Technology such as the Orcam is what has blessed our life.
Pumpkin spice cereal.
Oh yeah. Orcam My Eye is great for any eyesight loss.
Then he climbed up the tree.
And once I received the Orcam My Eye, it enabled me to read for them before they went to bed.
Orcam changed my life. It gave me an opportunity to have a break. I was able to go read a book myself.
Orcam, empowering people who are blind or visually impaired to live more independently. Call now, 800-718-5743.
Anytime, any place. Watch CNBC Primetime live.
Yeah, baby!
Woo! Catch up on demand on the all-new CNBC app.
There's unbelievable technology here.
Easier than ever to find the shows you're looking for. Discover new ones.
This is amazing. Wow.
Go behind the scenes.
That's why I watch CNBC.
Plus, access to CNBC podcasts. Right now, 10-minute free preview every day. Now available in the App Store.
The American spirit. Inherently competitive. Always driven with an appetite to succeed. Perseverance is paramount. Knowledge, essential.
Good morning, everybody. Welcome to Squawk Box here on CNBC.
That's what drives us. It's in our DNA to provide the information you need to propel your dreams forward.
The US is preparing for a tough winter, with President Joe Biden warning that infections will rise in the Northern Hemisphere, likely driven by the new variant. At least 5 states have now reported local Omicron infections. Biden outlined his winter plan yesterday, saying there would not be more lockdowns, with the focus being instead on widespread testing and booster shots. All international travelers will also have to be tested pre-departure, regardless of their vaccination status. Biden called for unity, asking that political differences be set aside in the fight against the pandemic.
As we move into the winter and face the challenges of this new variant, this is a moment we can put the divisiveness behind us, I hope. This is a moment we can do what we haven't been able to do enough of through this whole pandemic. Get the nation to come together, unite the nation in a common purpose, to fight this virus, to protect one another, to protect our economic recovery, and to think of it in terms of literally a patriotic responsibility rather than somehow you're denying people their basic rights.
The hotel industry is reeling under the pressure of yet another COVID wave, with the new Omicron variant adding to the fears that strong recovery seen earlier this year could be interrupted. Hilda Perez Alvarado joins us, who is the global CEO of hotels and hospitality at real estate giant JLL. Thank you very much for joining us, Hilda. We have seen a slight recovery now in the leisure and business travel segment. And if you look at the fears around the new variant, even with the suggestions from US President Joe Biden that further lockdowns will not be required, we still have extra measures. Do you think that derails the recovery we've seen in segments of the travel industry?
Good morning, and thank you for having me. I think it does, but just in a temporary fashion. So what we're seeing is those properties, those hotels that cater to the domestic clientele, they will continue to do fine. What these measures do, though, is that they create uncertainty as it relates to international travel. And so maybe people who would be taking a trip abroad may hold back just because they don't want to be stuck in a country or come back to, very onerous quarantine guidelines. So it may put a slight dent, but, having said that, I just wrapped up a roadshow here in Europe meeting with investors this week, and the sentiment is still very positive.
What we saw in the UK over the course of the pandemic, when international travel was restricted, and even if it came back in a big way and there was still any form of hurdles to that travel, people just resorted to these staycations. And that meant extraordinary prices, right, for the accommodation, for the quality of accommodation. Is that now the likely scenario, at least short term, where we're going to see more pricing pressure to the upside around staycations?
I think so. If you look at what has happened over the last 2 years, there's been a massive accumulation of savings. And the good thing is that the consumer wants to spend, right? So they have the means to spend, they have the willingness to spend. The thing is that they are now retained, if you will, in their own country. So those properties, those establishments, those stores that are catering to people domestically, they will continue to do absolutely fine. So we are seeing this gigantic wave of demand of the consumer wanting to travel, experience, consume, dine, wine, you name it, but they cannot go overseas, or they opt to not go overseas because of these restrictions and the headaches really to have to deal with an ever-changing measure. The way we see these restrictions that are being imposed currently by the government, we see this mostly as the biggest vaccination campaign so far. If you see, it's not that the US is shutting borders, for example, they're just requiring for people to be vaccinated or to have PCR tests. So, the demand is still able to come. It's just a little bit of a hurdle. But I think you hit the nail in the head. Those properties that are catering to domestic, to local clienteles will continue to do absolutely fine. We will see additional pricing pressure. And, and our investors, like I said, are very bullish. We see this more as a temporary issue. But the reality is that people are long on the sector. On hospitality, real estate, and anything that has to do with travel and tourism. The last point I will make is that there does seem to be a gravitation towards any asset that caters to leisure. So staycations, resorts, etc. Anything that caters to leisure, outdoor hospitality will continue to do very well. And the economic sector, the budget sector will also continue to do very well, just because that's a very efficient box that maybe doesn't have to rely or depend on some of the labor issues that we're seeing.
Gilda, as far as the restrictions are concerned at the moment, mostly I think what's being considered is increased testing. And that seemed to be the message coming from President Biden overnight. In your experience of the last 2 years, does that announcement in itself lead to a wave of booking cancellations?
Yes, but because of the inconvenience and the fact that some of the rules aren't very clear. I traveled to the UK on Monday. I was concerned on Sunday as to what the rules were going to be. Everybody that I asked had different interpretation of the rule, but I still went and it was absolutely fine. I came back last night. But it is that. It's, are the rules going to change when I arrive? Am I going to be able to get back? What does this whole thing mean? Every country has very different testing requirements. I traveled to the Middle East over the summer. Every country has very different requirements, and that creates a hassle. But, where there's a will, there's a way. And so those of us who need to travel, want to travel, will continue to travel.
Gilda, final question for me. I'm not too worried about the hotel industry. I think it will survive well, but there's a lot of real estate in city centres, and I saw it in London when I was walking around the other day, just to have a real good gauge, that is empty, and I can't see it coming back anytime soon. What's going to happen to the real estate properties that were restaurants and bars? What's going to happen to them in the short to medium term?
It's an excellent question. There's a lot of real estate that needs to be repurposed. So, the longer these properties sit idle or empty, the more capital that is going to be needed for them to come back, to be plugged back into the system. City center properties, those that are extremely well located, will absolutely come back. So I think we're in a little bit of a temporary hurdle at the moment. Pricing is very expensive. So not just goods and services, but also real estate. We've not seen the dip that we've seen in the stock market. We have seen a run in pricing. There's just way too much capital chasing very little property. So I do think that maybe pricing needs to settle, but there's always demand for well-located properties. Right. And, also the hospitality model is changing, guys. So in some of the owners that we're speaking to, a lot of the traditional hotels, maybe they become, maybe they get transformed to co-living. Yes, or an alternative use that it's the highest and best use, but the properties will be
We've got to leave it there. Hilda Perez Alvarado joining us from JLL, talking about the leisure and travel market, and we've got the market open right upon us. Stay tuned. We'll be right back.
Tune in for Tech Check. Zero in on opportunities. Red hot startups from the East Coast and the West Coast. The go-to destination for investors. Tech Check. Weekdays, 11 a.m. Eastern, 8 a.m. Pacific. CNBC.
And introducing the middleweight champion of the world.
I guess we know what to get Dad for Christmas.
Order now for a $149 bonus offer. Visit fightcamp.com for more details.
We've been spending a lot more time than ever at home these days. So maybe now you've just noticed cold air coming in from a couple windows, or that your patio door isn't closing fully, which means you're losing heat in the winter, losing cooling in the summer, losing money all year long. And that means now is the time for new windows and patio doors from Renewal by Andersen. Most installations are usually done in just one day. Renewal by Andersen windows and doors can help lower your heating bills and air conditioning bills with their most energy efficient glass available. Only their windows are made with Fibrex material, proven to be 2 times stronger than vinyl. And they're backed by a 20-year warranty. And right now, when you buy one window or door, get one at 40% off. Plus, there's no money down, no payments for 12 months, and no interest for 12 months. So call right now.
1-800-203-7194. 1-800-203-7194. Do you need a boost in sales? PeopleSmart.com helps you find emails and direct dials in seconds. Just search a name, job title, or company, and you can find detailed contact information. Book more appointments and close more deals. Prospect smarter with PeopleSmart.com.
Do you worry about going to the dentist? Well, relax. The Carefree dental card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree dental card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree dental card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-997-2117 to receive your free Carefree dental card information kit.
Technology only matters if it makes a difference in the guest experience.
Fort Knox with John Fort. Subscribe to the podcast now.
European stock markets are open for trade, and the early Friday session has suggested a bit of a clawback versus yesterday's trade. The markets here, again, taking another wobble amid all the complex issues, namely the new variant, but the slightly different change in policy tone from the US Federal Reserve. Market stateside, though, recalibrating yesterday, again, bouncing to the upside, very volatile trading week, which left us a little bit out of lockstep as our market did sell off over the course of the trade. That said, as we count down to the US session, we have got a fairly flat picture. We've got the jobs report coming out later on today, and don't forget data, very much a big piece of the puzzle at this stage as to how quickly we see the wind down of the asset purchase program stateside. That is part of the agenda coming up later this month from the Fed, but also any potential liftoff in interest rates next year. So there's a lot for investors to try and ascertain at this point, and you can see markets just trying to move into positive territory, a fairly modest 0.6% upside on the Stoxx Europe 600, not quite recapturing all of the losses yesterday, 1.1+% we were down, but it does move the direction towards the positive side a little bit more. Still over the course of this week, we've been traveling higher for the benchmark, up roughly 30%. So adding to that position so far. Let's get into what we're seeing at the individual sectors. It is a fairly broad-based sweep into positive territory, and most of the sectors, all of the sectors trading positive. Oil and gas at the top, food and drink at the bottom. This sector travels up by about 1/3%. So we are seeing some fairly decent ranges, even for the underperformers. Healthcare, rather mix of underperformers along with construction, but still up 1/3%. Basic resources leaning higher. Telcos, Nokia, one of the top ones in that basket. BT performing nicely. Chemicals, 0.6 higher. Akzo Nobel, the top performer in that basket of stocks. Media just moving forward as I take a check on it. WPP, Pearson, two of the top performers in that basket. Industrials also marching higher. So we are looking at some fairly firm percentage ranges here. Household goods, 0.9 higher. Pandora, one of the top performers. Banks, 1% in the green. That does follow what we saw stateside, and it was a fairly decent bounce in the banking basket of stocks yesterday. The ETF, SPDR of the banks, that gained 3.43% yesterday, breaking a losing streak. So definitive move higher, and that has bolstered the banking basket here this morning. Auto stocks led by Renault. Travel and leisure is one of the top performers. So perhaps that does tell you about the narrative of how the market is viewing the variant at this stage. Oil and gas, 1.4% higher, led by BP. And let's get into what we've got at the index level. 7,193, we are just off the 7,200 mark for the FTSE. That's a bounce of 0.9%. Over the week, we've had 2 negative sessions out of 3. The market down yesterday, but over the week, still trading higher, which is fairly interesting as we've seen the US markets not necessarily hold on to a lot of their territory over the course of the trading week. For instance, the Dow has been down 0.75% in contrast to the week-to-date gains we've seen on these European markets, 1% higher for the French market, so outperforming versus the UK and German markets. We've got 0.9 on the DAX, and you can see a similar picture really cropping up on these peripheral indices and on the SMI, a little bit left behind versus the other markets. But again, that comes down to the sectors that constitute the broader index. I want to get into that oil story a little bit more because oil prices are trading high today, and the energy basket of stocks also bouncing after OPEC Plus said it will be ready to step in if the Omicron variant poses a bigger threat. But the stability very much helping out the direction here. And they are nice gains. The 2.3 on BP is solid and 1.3 on Shell. The largest semiconductor chip merger in history is in jeopardy after US regulators moved to block NVIDIA's planned acquisition of British chip firm ARM. The Federal Trade Commission cited antitrust concerns, saying the proposed deal would give NVIDIA control of computing technology that its competitors rely on. And don't forget, ARM was always expecting a number of regulatory hurdles, but this FTC challenge is a significant one, and already the likes of Gartner is saying it may derail a takeover here altogether. So it's
fascinating on that story, but just to see the way the markets are settling ahead of the latest non-farm payrolls number, the backdrop, initial jobless claims rose slightly to 222,000 last week, but the figure was lower than economists had forecast. It's higher than the previous week's 194,000, which was the lowest figure since 1969. Continuing claims dropped below 2 million for the first time since March 2020 in the early days of the pandemic. The weekly figures imply a robust recovery in the US labor market. But we'll get more insight, as I say, when we hear what the non-farm payrolls number actually looks like. Economists are expecting that figure to grow, with unemployment falling to 4.5% from 4.6% in October. Wage growth is also expected to accelerate slightly, supporting the Fed's case for tighter monetary conditions.
Let's get to Bill Street, CIO with Quintet Private Bank. Bill, it feels as though we're setting up for a fairly interesting data point today, given how uneven the Fed commentary has been around inflation. How market moving do you think the non-farm payrolls report will be?
So we're looking for quite a strong payrolls report. I think, look, at the moment and going into next year, interest rates are going to start moving forward. So I think we are going to have a strong report. We've got a lot of stimulus coming out off. Some of the checks are winding down. So people are coming back to work and the economies are picking up and getting more open. So it will be a big number. I think it will be positive for the markets, and interest rates will start moving as well.
We have seen central banks jawbone before without delivering any action, and BOE was a great example of that recently. The market was primed for some move and they didn't really get it. When we talk about the Fed here, there's still a lot of water to navigate. We've got the variant outcome from scientists in coming weeks. We also potentially have some of the inflation pressures fading as we look into 2022. How likely is it that the pathway that we're seeing now on rates is actually the one that's going to end up unfolding for markets?
Yeah, it's a good question. There's a lot in that to unpack. Well, maybe move the variance to one side for a moment, come back to it. But look, I think the context here really is that as we came into 2020, we had interest rates at, say, 1.75 in the US as an illustration. And then we've moved into zero interest rates and huge fiscal stimulus through quantitative easing with trillions of purchases going on. What we're talking about here, what the Fed is talking about, the central banks, is just taking some of this back out of the system. We're not in that emergency room anymore from the economic perspective. So moving gently back into a place where you have no more asset purchasing, and then you can start looking at full employment and interest rates, traditional interest rates, is a reasonable expectation. It's not going to happen overnight. It'll probably take another 24 months to finish tapering and adjust policy. But even when we get there, arguably that's still a very, very relaxed interest rate environment and stimulating for the economy.
Bill, if that was true, why does Powell keep talking about inflation being frustrating then? And he's resting this word transitory. Clearly, he doesn't believe it's transitory any longer. You're sticking to your guns, though. You think it disappears next year. Why do you have a different opinion?
Yeah, so we need to unpack the two issues, which is actually taking some of this stimulus out of the system that we just talked about, the tapering in interest rates, and this sort of shock we're getting from inflation at the moment. Now, the adjectives aren't very helpful, temporary and transitory. What you need to look at is what is actually happening. Where are the shocks coming? We do know there are supply chain shocks and disruptions, and the piping isn't working. And we do know demand is picking up. So that confluence of events is going to create a little bit of mayhem for policymakers in terms of trying to work out where interest rates fit into that narrative. But what we do know, and what we are beginning to see, is some of these supply chains are opening up. Some of these energy prices and commodity prices are already rolling over. And headline numbers will come down. They have to come down mathematically anyway, year on year, quarter on quarter. So you'll see this ebbing away. And I suspect the inflation debate will be more focused back onto moving interest rates to a more normal environment based on moving away from this sort of super emergency status we're in.
We also know that if you look at average hourly earnings, they're running at something like 6% annualized, Bill. I mean, that isn't about supply chain problems, is it? That's about tightness in the labor market and the fact that employees are demanding more for their labor.
Absolutely. Well, I think it's a different type of supply shock. Yeah, I think it's a labour supply shock. And I don't mean that sort of pejoratively across the whole of the labour market. If you look at the pressures on labour costs, it's very sector driven. So hospitality, for example, has got the highest level of real wage growth. But some parts of the service sector, financial services, for example, still have negative real wages. So it's not as simple as saying, actually, wages are going up across the board. Is there a spiral of wage inflation or inflation expectations? No, there isn't. And don't forget also, if we look back from the beginning of 2020, we've still got about 5 million lost jobs, even to get back to where we were, let alone how many jobs we would have created over the last 24 months, which would take it closer to 9 to 10 million. So there's still a big gap in the labour force that hasn't been filled. However, saying that, 4.5%, if that's what comes out today, is still quite a tight number.
But Bill, there are less workers out there than there are job vacancies at a record level in the United States. 0.7 is that ratio now to actually workers available to fill jobs as well. Your 5 million figure, I've got to be honest with you, Bill, I think it's out of date. It was 5 million jobs lost, but that doesn't mean to say that those 5 million jobs need to come back again, because people are leaving the workforce for all kinds of economic reasons, social reasons, possibly COVID reasons, in their droves on both sides of the Atlantic. Do you need to revisit your 5 million figure, Bill, for the future rather than the past?
No. Morning, Steve. No, not at all. Because really what you're looking at is a baseline number from where we were at the beginning of 2020. Don't forget, the economies have been growing at 6% year on year since then, through the last 24 months. So we would have expected a huge amount of labour growth and employment creativity, which hasn't happened. Now, I do accept the point that the participation rate has fallen at the same time, but part of that is difficult to really assess whilst there's a lot of stimulus checks out there, which we are seeing coming off, furloughs in the UK. So I do expect the participation rate to pick up.
Bill, don't think I didn't notice that frustrated sigh when you said morning, Steve. So I've noted that one, my friend. Okay, here's my last stab at this, and I'm just moving it along to margin compression that I believe will be the case at corporates as wages pick up as well. But do you believe it, more importantly, as well? Because I can't help thinking that we will go back to start talking about peak margins again very soon over at corporates.
Yeah, look, there will be, as the labour force gets tighter, there will be, this will come through margins. The margins will be compressed slightly, and that will impact earnings as well. So you will need to look at how the labour pressures and the labour costs come through different sectors, absolutely, which is part of the point earlier, really, is that the labour pressures and the sort of wage pressures isn't across the board. It's definitely a sector-by-sector phenomenon.
Bill, thank you very much for joining us. We appreciate you taking the questions, even some of the challenging ones. Bill Street with us, CIO, Quintet Private Bank. I'm going to take you back to the market action here, and Roche is one that's on our radar. I'm not seeing a huge amount of movement, pretty much just tilting higher and underperforming the market. Roche is developing new testing kits to help identify the Omicron variant. The Swiss pharmaceutical giant says the 3 new tests developed by its subsidiary TIB Molbiol are able to differentiate between the mutations in the new variant. This could help researchers study the spread of the new strain compared to other variants. And let's push on to Allianz, which has raised its medium targets, also increasing shareholder returns. The German financial services firm said in its 3-year strategy outlook that it would now target annual earnings per share growth between 5% and 7% for the period of 2022 to 24 and bump up its dividend by 5%. Allianz says it expects to generate 12 billion euros excess capital through its operational plans. The 1.4% pop in the share price, improving the year-to-date performance, still slightly weaker though. And so Daimler in the auto sector, it is seeing a slight dip in the session. Its supervisory board has approved a 60 billion euro investment plan for Mercedes-Benz cars and vans from next year right through to 2026. This comes a week before the planned spin-off of Daimler Trucks and Buses from its core cars business. And Glencore in the resources sector, the stock 0.6 higher at this stage. It is in the process of selling 10 assets while putting another 15 under review. The Anglo-Swiss miner has so far sold its Bolivian zinc mines and a copper gold mine in Australia as it aims to get rid of assets it views, quote, are not fit for purpose. Earlier this week, the activist investor Bluebell Capital called on the company to show its commitment to clean energy sources. And I want to take you elsewhere to Shell, which has cancelled plans to develop an oil field in Britain's North Sea. The oil giant said the economic case for investment into the Cambo field isn't strong enough. This after the proposed development drew the ire of climate activists. So it does seem as though we're getting some changes around portfolio based on ESG principles, Steve.
Yeah, and Hassel, Karen, I've done a lot of work on Cambo, funnily enough, when I was up in COP26. And it's something that Nicola Sturgeon's been asked an awful lot about. It's stunningly controversial. And I don't know if it's about the economic case from Shell. I would be surprised if it isn't just about the hassle factor, and they just don't know if they can be bothered given the amount of fires they're fighting, as you say, on an ESG front already. Anyway, coming up on the show, the legendary investor who anticipated the Enron collapse 20 years ago has just revealed 2 new short positions. We might tell you a little bit about that after the break if you're lucky.
Had either of you ever invented anything before?
Nothing.
We went from 5 employees to 500.
Strange Success with Jay Wells. Subscribe to the podcast now.
Let freedom in. Freedom to work, freedom to play, freedom to simply be. Need a space to call your own? Four Seasons has got you covered no matter your style or budget. To ensure your well-being, our teams are temperature checked, wear gloves and masks, and maintain social distancing protocol. In support of hardworking Americans, take advantage of easy payments, and for a limited time only, call now and save up to 40%. With products that are American-made and American-inspired, it's time to let freedom in.
Do you worry about going to the dentist? Well, relax. The Carefree dental card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree dental card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree dental card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-997-2117 to receive your free Carefree dental card information kit.
The CNBC app has new features just for you. With real-time market data, create custom watch lists, get stock quotes, and get your own personalized alerts. Keep up with top videos. Get the latest podcasts. And now you can watch CNBC live with a daily free preview.
Let's just say it's your opportunity.
The CNBC app. Download it today.
The American spirit, inherently competitive, always driven with a hunger, ambition, and an appetite to succeed. The pursuit of prosperity can be unpredictable and thrilling. From breakthroughs to breakdowns, the launches and the crashes. Perseverance is paramount. Knowledge essential.
Good morning, everybody. Welcome to Squawk Box here on CNBC.
That's what drives us. It's in our DNA to provide the information you need wherever you are to propel your dreams forward.
The largest semiconductor chip merger in history is in jeopardy after US regulators moved to block NVIDIA's planned acquisition of the British chip firm ARM. The Federal Trade Commission cited antitrust concerns, saying the proposed deal would give NVIDIA control of computing technology that its competitors rely on. The FTC move comes a month after British regulators said they would launch a similar in-depth probe of the deal. Shares in Nvidia closed 2% higher. Don't forget, this has been a challenging one anyway from the outset. Regulators were always going to have a look over this, but now, given the supply chain bottlenecks we have around chips, it's become a much more challenging conversation for those behind the deal making. And on our website, you can find out why one analyst says it's highly unlikely that this deal will go ahead. That story is on cnbc.com, Steve.
Right, thank you, Karen. Chinese market regulators have said that Tesla is recalling over 21,000 Chinese-made Model Y vehicles due to issues with its steering knuckles. I have no idea what a steering knuckle is, by the way. This as Elon Musk is offloading more Tesla shares. Regulatory filings show the CEO has unwound another 934,000 shares in the EV maker, worth around $1 billion, in order to meet his tax obligations. Since November 8th, Mr. Musk has sold shares worth $10.9 billion US. They closed, in terms of their share price, down 1%. Now, Southeast Asia's super app, Grab, skidded in its Wall Street debut. The ride-hailing and delivery company opened 19% higher before reversing course. It was the biggest US listing for a Southeast Asian firm, following a record-breaking $40 billion SPAC merger with Altimeter Growth Corp. The ride-hailing giant is still posting losses. They're quite large losses. We might discuss that in a moment. But the CEO, Anthony Tan, told CNBC he's confident in the company's path to profitability.
We don't view growth and profitability as mutually exclusive, Andrew. We operate in a market with a large market opportunity and low penetration across our verticals. So if you just look at food penetration is 12% in Southeast Asia versus 21% in China. Mobility is 3% in this region versus 12% in China. And we've been able to build a great track record of achieving significant top-line growth while taking massive steps towards profitability. So our mobility margins, for example, 12% as of Q3 2021. These are industry leading and have been relatively stable for several quarters. Our deliveries is only a 3-year-old business, but already break even in a majority of our markets. And we'll apply a similar approach to cost optimization to deliveries as we have done in mobility. So we do believe we have a cost leadership advantage, as I talked about, as a super app. And more importantly, we're offering an ecosystem of highly complementary services that address high frequency, everyday needs all through one app. So we're scaling and we're growing and investing in this growth while making sure we're exercising cost discipline. So I'm confident we have this clear path to profitability because of the super app model.
And what's that timing look like to you?
Well, we're just going to keep executing upon this long-term strategy. And we're seeing, as I shared, mobility margins are strong. We're seeing in our deliveries business break even just after 3 years in majority of our markets.
The Chinese ride-hailing giant Didi says it will delist from the New York Stock Exchange and move to Hong Kong instead. Shares plunged last week amid reports Chinese regulators were pressuring executives to delist from the US over data security concerns. Legendary short seller Jim Chanos has 2 new companies he's betting against. One is the sports betting company DraftKings, and the other is food delivery app DoorDash. The founder of Canecos Associates is well known for anticipating Enron's historic collapse, which happened 20 years ago this week. And it's interesting, this question of DoorDash, I think in particular, as we were just looking at the performance of Grab and some of the concerns about these new companies that have come to the market, obviously with a model that is designed like a flywheel. I think that's the active description for this kind of business model that they use in Silicon Valley, which is ultimately it grows and gains momentum. And as it grows, it uses its equity to then buy other businesses, which DoorDash has been doing. But ultimately, the scale begins to generate profitability. I think Jim Chanos is saying at this stage, maybe some of the spokes in this flywheel aren't actually delivering or performing as they should be. This is a flywheel that's running out of momentum, and maybe now is the time. If they can't do it in this environment, which has probably been one of the best environments ever for people locked down and ordering food delivery, then when can they do it?
Yeah, I'm just looking at some of the numbers, and I can see why he's got an issue, the step up that you're seeing in some of the costs. But if you consider where they're not at the end game yet. These are businesses that continue to evolve. And something I didn't know about the company until recently was that they are trying to bolster advertising. So not just click through with restaurants and orders, but actually, these big banner ads as well, and then ordering through those ads. So it's a very different business model, and that's just one theme, like getting an advertising component into a delivery business, got the delivery orders themselves, and we've, of course, got the new grocery business, quick groceries that these takeaway delivery apps have got into. So it's a moving target in terms of what this business looks like at the end of the day, and I think it's quite hard to make a call at this stage, but I can see why there are short-term targets when, let's face it, there's a lot of offerings in the sector these days, more and more listings coming to market, Steve.
Well, it just becomes smoke and mirrors though, doesn't it, Karen? If you have a business model that you think works on a certain product, like delivering people from one place to another, that business model should surely be able to stand on its own two merits. And the profitability from that should have a trajectory. And then you say, well, actually, we can't just make money out of delivering people from place to place. So we're going to deliver food from place to place. And actually, still, that one doesn't necessarily seem to deliver the right kind of profitability. So now we're going to add advertising in there as well. And it's like looking at the best of Amazon, looking at the best models from 1999, 2000, 2001, and then just chucking it all together and hope that the investors can't spot that the core business model actually doesn't actually work. And that's what we've basically got in a lot of these companies that keep promising us growth. I love this. I'm reading an Ocado report here as well. And it's like, oh yeah, we still lost money, regardless of the conditionality of home shopping, regardless of the stunning boom we've seen in revenues and what have you. But actually, we've got a different measure we prefer. We call it underlying earnings. It's the company's preferred measure because it strips out so much, we look so profitable. And it's the same with loads of these companies. If the basic model that they've got for a business doesn't work, it seems to me that more and more and more we're getting add-ons as well, which turn them into these kind of almost internet conglomerates as well. So you can't actually see where the real growth is. You can't actually see where the real profit is. I mean, look at that interview with Andrew Ross Salkin there with Grab as well. I'll just read a bit of that transcript again, because he was talking about a clear path to profitability because of the super app model. So Andrew Ross Salkin asked the most complicated question of all time. What is the timing looking like to you? i.e., when are you going to make money? Well, we're just going to keep executing for the long term, says Mr. Tan, and we're seeing as a share of mobility margins long. All our businesses are a load of our businesses are making profitability, or break even, I should say, in 2 years. They're not saying to us we are going to be a profitable business in 2 years. They're saying we're reaching break even in the majority of our markets, but they're still throwing off enormous losses. Let's just go back to Grab again. They lost $800 million in 2020. They're projected to lose $600 million in 2021. How long are investors supposed to sit with companies that have supposed growth models on basics of their business that don't actually work as well before they reach some form of profitability? I ask the question because some of these are going to be great, but the vast majority of them, they're not going to make a bean, are they?
Steve, you're not wrong to question the business model and how they keep on changing. I think the term super app is worth picking up on, because if you think about what Facebook, Meta did back in the day, there was a social media platform. They tried to capitalize on that by serving up ads, and now they do e-commerce and marketplace. So they continue to evolve. But we've got a very long leash here for the sector, and the question is whether that gets reined in as we talk about a macroeconomic environment where we may have higher interest rates down the track. And does that change the time frame for some of these companies? I think it's a race against time for some of them, and it's been beneficial for the delivery apps to have had this pandemic where they've seen supersized trends to speed up the business model. But the complexity you mentioned is because if you look at individual markets, some of these markets, they have critical mass. They have economies of scale in these markets. If you think about the ones we use, they're very dominant. I mean, Deliveroo is a big one in the UK, but if you go to other markets, it barely has a presence in some of those markets. This does tell you the challenge where they don't have break-evens because they don't have the scale as yet, and that does require the deep investment in marketing and expenses to build up the operations in these countries. So I think it is early days, and the question is whether interest rates move before the profits start to come through these sectors and super apps anytime soon.
Let's wrap it up. Moving forward, you can watch the full interview with Jim Chanos on cnbc.com. Steve.
Well, back in the real world, coming up on the show, we bring you the latest COVID news as the Omicron variant spreads across Europe.
This is amazing.
I love what car that is.
Oh my goodness.
Yes!
Shea Leno's Garage, all new Wednesdays 10 Eastern.
Orcam My Eye continues to enable me to live the life that I had once lived before when I did have eyesight. I came face to face with a suicide car bomb. And once I really understood that I would never be able to see again, it was beyond devastating.
It's often the small things in our life that make the greatest impact. Technology such as the Orcam is what has blessed our life.
Pumpkin spice cereal.
Oh yeah. Orcam My Eye is great for any eyesight loss.
Then he climbed up the tree.
And once I received the Orcam My Eye, it enabled me to read for them before they went to bed.
Orcam changed my life. It gave me an opportunity to have a break. I was able to go read a book myself.
Orcam, empowering people who are blind or visually impaired to live more independently. Call now, 800-718-5743.
Let freedom in. Freedom to work, freedom to play, freedom to simply be. Need a space to call your own? Four Seasons has got you covered no matter your style or budget. To ensure your well-being, our teams are temperature checked, wear gloves and masks, and maintain social distancing protocol. In support of hardworking Americans, take advantage of easy payments, and for a limited time only, call now and save up to 40%. With products that are American-made and American-inspired, it's time to let freedom in.
Put everything we had into this.
I taught myself how to do Facebook advertising.
I went to Harvard. I graduated, top of my class.
World cookie dough domination.
Wow.
Do not miss the chance to get in. Introducing Goat Yoga.
What? This entire product has been my life.
Do not shut it down.
We had an opportunity. We took it.
My family is going to come in here and tackle you. Do this deal.
Shark Tank, Sunday through Thursday, starting 8 Eastern. CNBC. Get yours.
Tune in for Tech Check. Zero in on opportunities.
Where are all of these batteries going to come from?
Red Hot Startups.
It is one of this year's most anticipated IPOs.
From the East Coast.
We are watching some of the key players in the alternative energy space.
And the West Coast.
So many new streaming rivals.
The go-to destination for investors. Driving the future. Tech Check. Weekdays, 11 a.m. Eastern, 8 a.m. Pacific. CNBC.
Welcome back to Scorebox. These are your headlines. So, European equities are rising after Wall Street recovers in some fashion ahead of today's jobs data, whilst oil prices stay in the green, with OPEC Plus keeping cautious over Omicron. Turkish inflation spikes to over 20% in November, amid the lira's historic declines, whilst producer prices skyrocket almost 55%. US regulators sued to block the sale of ARM to NVIDIA, citing competition concerns around the largest semiconductor chip merger in history. And the EU says Omicron will be responsible for over half of all COVID infections within months, as scores test positive for the variant after a Christmas party in Oslo, and as Germany seeks compulsory jabs.
A general vaccination mandate should be decided by the Parliament. We have asked the Ethics Commission to work on a recommendation, and the general vaccination mandate could start in February 2022.
A European stock markets have been open for half an hour. We have given back some of this territory. It's been a very positive start on the back of the Wall Street action where we saw a pop on the Dow, the S&P and NASDAQ. But a lot of gains just not sticking. We're up about 0.6% as we began the trading session. You can see up about 0.25% at this stage. But it is a big day stateside as we talk about how central banks are likely to react to pressures through the system. Already we've seen the retiring of the use transitory around inflation. And now we are setting up for a fairly decent payrolls report today. The question is whether those jobs are being added, whether workers are coming back into the workforce, or whether they've still been concerned about COVID exposure. And that's particularly relevant as we talk about a fresh variant. And the market is taking stock of those events clearly and waiting it up for more information. But so far, we've got the market just grinding higher. The early picture on the sectors was positive right across the board. And the sectors now, as we take another look, just showing a couple of patches of red around food and beverages, telecoms, basic resources. They are slipping into negative territory. Best performers are still solid, 1.5% on travel leisure. That's a recovery trade here in Europe. Oil and gas, decent, 0.8% despite OPEC Plus also holding the line on its production levels that it had planned, or despite the uncertainty around this variant. And that's still left the market somewhat supported on spot prices and energy at this stage. Insurance is up 0.7. Let's take a look at the stocks. Big ones on the move today. Deliveroo down 4.7%. Dufry in the airport retail market sliding in trade today. We've got some movements to the upside in the oil market and airline space. Lufthansa is clearly the airline stock in the move, up 2.5%. Steve.
Thank you, Karen. Right, the European CDC says it expects Omicron variant to become Europe's dominant strain within months. More than 30 countries have now reported cases 1 week after it was designated a variant of concern by the WHO. Norway has reintroduced COVID restrictions amid growing Omicron cases, with at least 50 people reportedly infected at a Christmas party. All inbound travellers must now take a test within 24 hours of arrival, no matter what their vaccine status. Areas with high infection rates will have work from home rules reintroduced, as well as mask mandates. Jeffrey.
France's health ministry says there are currently 9 cases of the new Omicron variant confirmed in the country. The health minister, Olivier Véran, said they expect the current wave to peak in late January, but warned the renewed uptick in cases could put a strain on the healthcare system. This as France reported nearly 50,000 new infections for the third day in a row. Germany has imposed a lockdown on the unvaccinated, who will be barred from visiting almost all businesses and cultural venues apart from pharmacies and food shops. Outgoing Chancellor Angela Merkel has joined her successor Olaf Scholz in backing mandatory vaccines as a means to increase Germany's vaccination rate. Annette, I don't want to lose the opportunity here just to celebrate and take a moment to see the celebrations surrounding Angela Merkel as she bows out at this point. So hopefully we're going to just have a look at those pictures, and we'll hear what she had to say about the vaccine in just a moment, and Omicron. But I've been practicing this morning in anticipation of being able to use it. The phrase is "Du hast a Farbfilm vergessen." Can you explain to us why that matters?
Well, actually, that's a song back from the days in the GDR. In the GDR, everything was really grey. I don't know if you've ever been there. When I was a kid, I was there. And it honestly, everything was grey and the light was dim. And it is a song from a very, sort of very well-known punk artist who was from the GDR as well. And Angela Merkel was raised there, of course, and it's just part of her life, which was reflected in that song. But let me bring you back also to the COVID situation, because clearly she's leaving the country in a moment of crisis, which is unprecedented. And that's what she was saying as well, over and over again, that she's wishing the new government to come up with reasonable and also successful policy measures so that one day we can all be light at heart once again. So currently the COVID infection rates are somehow leveling out, but at a very high level. It's no exponential rise anymore every day, but still it's far too high. And it varies in some regions of the countries. Of course, the hospitalization rate is far too high, and also the capacity in hospitals are coming to full capacity. For example, in Saxony, the Prime Minister yesterday was quoted that we have to shut it all down because clearly we are approaching a very, very difficult situation with hospitals being completely full already now. So that's the situation here in the country. It's very sort of regionally diverted, I would say. In some regions it's okay, in others not. But still, of course, one of the big issues here as well is how long should the vaccination status actually exist after the second jab? And here, Angela Merkel has a very pronounced idea of what we should do. Take a listen.
The status of vaccination will not stay as fully vaccinated after 2 vaccinations. As also discussed on the EU level, after 9 months, the second vaccination will not be valid anymore, which means that the booster, the refresher, is extremely important to keep the status as fully vaccinated.
So yesterday evening at 7:30, Angela Merkel was getting her farewell from the military. It's the highest military ceremony. It has an awkward name in Germany. It's called the Große Zapfenstreich, which more or less is might be translated into a grand tattoo ceremony in military terms. So what happens there is that the German military officially bids her farewell, and Angela Merkel also again had the opportunity to not only listen to the music she actually selected for it, but also say something about her past 16 years. Perhaps we take a listen in here again.
Standing here in front of you today, I feel humility and gratitude above all. Humility before the office that I was allowed to exercise for so long. Gratitude for the trust I was allowed to experience. I was always aware that trust is the most important asset in politics. It is anything but self-evident. And for that, I thank you from the bottom of my heart.
So 16 years of Angela Merkel, of course, looking back at those 16 years, she was the chancellor of various crises, and she has handled those crises quite well for Germany, especially on the international stage. She was criticized not to modernize Germany fast enough, and that might now be the job for the new government. But bottom line is she's sort of giving Germany to the next government in a state of crisis, of Corona crisis, and that's what they need to tackle first of all before doing anything else. Olaf Scholz will be sworn in on Wednesday next week when Parliament is electing him, and then shortly after that we might see the Bundestag also voting on those mandatory vaccinations, which could then be effective from February onwards.
Thank you very much for that, Annette. Jeff and I having a little bit of a interesting debate around the use of a different word to transitory, but apparently it's a word bingo, and it's hump. According to the ECB, they're saying inflation profile looks like a hump. You were debating whether that's a camel.
Yes. Well, let's hope it's a dromedary and not a double-humped camel, because we don't want another bout of it, do we? If it is primarily about viruses and supply chains. But I think it's fascinating. Christine Lagarde clearly under pressure to come out and talk about inflation at the moment, given the fact that the Fed has dominated the narrative and Jay Powell has pivoted.
Yeah, she's put a bit of distance between the other hump, and that's the one in the United States. And she's saying the euro area is different from the United States. If you look at inflation, labor markets, slack, she's also, this is in a Reuters interview, I should say, she's also hoping that the hump eventually declines, and they project that inflation will decline in 2022, that they see it going towards target over the course of next year. And effectively, they've pulled out energy prices. They say they have reason to believe energy prices by the end of next year will have declined significantly. Companies, they're saying, more of them are saying bottlenecks will take until mid next year or the end of 2022. And that they're seeing a slight, in the November numbers, a slight decrease in bottlenecks impact. So already they're saying there is evidence around this turnaround, but they do point out there's still some unknowns around this variant, and the economic impact will depend on measures. So I think one of the other salient remarks here too is that they're talking about another wave was included in the ECB's adverse scenario. We're still in the range. So that's important as we talk about projections and just to what extent we're being derailed off that course by current wave and also variant.
Yeah, but there's a lot of assumptions in here, aren't there? And no reason to see this latest Omicron variant as any different from other variants that we've had to manage. That at this stage, I don't know whether the scientists would actually confirm that is the case. I mean, we heard from the guest that we had in the first hour that it was still a little bit too early to figure out just how infectious, just how deadly, just how long it's been around, just how well it will respond to the same vaccines and boosters that everybody's been given to deal with the Beta and the Delta variants. So, you know, she's putting herself out there a little bit, making these comments about the passage of Omicron and what it's going to mean in inflation terms and supply chain terms.
Let alone the European reaction, which is quite different to other countries. I mean, Lagarde is saying, I don't see any reason why we would not draw from learnings to live with the variant. And Joe Biden spelling out his measures to live with the variant, and that's, you know, wearing of masks and PCR tests before you hop on planes, the mandates too for some health workers. But in Europe, it's not always been the case where those sort of light touch measures, as we would call them, versus lockdowns, are going to be applied. We've already seen Austria go into that 20-day mandatory lockdown. So it does beg the question, if you see stronger restrictions in Europe, what ECB policy will have to look like on the back of that.
We've got a beat on the Italian services PMI, 55.9. So the IHS Market Business Activity Index for Services, 55.9 in November. That number just threw up from 52.4 in October. The expectation I had penciled in was for 54.5. So that's a lot better, I think, than the market was looking for. The analysis on this is that the services sector has enjoyed a strong and buoyant rebound, given that restrictions had increasingly being lifted in Italy. And we've got a number of PMIs coming through this morning on the services side that we will tell you about, which I suspect may look similar. Turkish
WHO pushes for a more coordinated global response to the pandemic. Yet again, it has to be said, as it urges countries to share vaccines. We'll have plenty more from Tanya's interview with the CEO of the WHO Foundation. That's coming up after the break.
Right now on CNBC Make It, living large on below market rent. Luxury for less.
When you step in, you feel like you're in another time period.
Stretching your dollars and lifestyle on CNBCMakeIt.com.
Let freedom in. Freedom to work, freedom to play, freedom to simply be. Need a space to call your own? Four Seasons has got you covered no matter your style or budget. To ensure your well-being, our teams are temperature checked, wear gloves and masks, and maintain social distancing protocol. In support of hardworking Americans, take advantage of easy payments, and for a limited time only, call now and save up to 40%. With products that are American-made and American-inspired, it's time to let freedom in.
Do you worry about going to the dentist? Well, relax. The Carefree dental card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree dental card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree dental card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-997-2117 to receive your free Carefree dental card information kit.
Let's be real. Sales is a numbers game. PeopleSmart.com can turn your list of prospects into accurate emails and direct dials, helping you hit that number faster and easier. Prospect smarter with PeopleSmart.com.
Commit to energy. Focus on innovation. Discover the next growth opportunities. Climate technology. All you need to know to invest in the future. The ultimate source. CNBC.com/climate. The American spirit. Inherently competitive. Always driven with a hunger, ambition, and an appetite to succeed. The pursuit of prosperity can be unpredictable and thrilling. From breakthroughs to breakdowns, the launches and the crashes. Perseverance is paramount. Knowledge essential.
Good morning, everybody. Welcome to Squawk Box here on CNBC.
That's what drives us. It's in our DNA to provide the information you need wherever you are to propel your dreams forward.
Let's get to Tanya, who's been looking at what the WHO is doing, what the WHO Foundation is trying to do, and with their Go Give One campaign. Let's get to Tanya now. Hi, Tanya.
Good morning, Steve. Yes, thank you so much. I caught up with the CEO of the WHO Foundation, Anil Soni, to ask him about the campaign that they're trying to address vaccine inequity around the world. And I started by asking him if the new Omicron variant is making things worse in their mission to close the gap in vaccine access. This is what he had to say.
There's a lot we still need to learn about the Omicron variant, and the World Health Organization is working rapidly with scientists to share data on its impact on transmission and on the effectiveness of vaccines. The fact that so many people are not vaccinated is why we have the threat of variants like Omicron, and that the solution is clearly to vaccinate the world and ensure that everyone has access to vaccine, is protected, and that we're reducing the population pool in which variants develop.
Well, what do you make of the global response to Omicron so far?
Well, first, I should say that South Africa and Botswana should be celebrated and applauded. What we need to fight this pandemic is good data on new transmissions, surveillance, testing, reporting. South Africa and Botswana are doing exactly that by sharing the data on Omicron as quickly as they did. The fact that the global community is responding quickly on the science is exactly what we need. The fact that there are knee-jerk reactions in terms of restrictions that make it harder for people to live their lives, that's worrisome. We need to follow the science. We need to follow the guidelines of leaders like the World Health Organization.
Why is there such huge inequality? Why are the richer countries not helping the poorer countries?
Less than a year into the pandemic, we had a vaccine, and less than a year later, we have that distributed to billions of people. That is the good news. The bad news is that less than 10% of people in developing countries have received a vaccine to date. We were supposed to get to 40% coverage by the end of 2021. It's December, and we look unlikely to meet that target.
Who do you hold responsible for this?
It's important to note that governments cannot do this alone, and governments are the representatives of people. What we've tried to do with the WHO Foundation is create an opportunity for businesses and people to do their part. We created a campaign, the Go Give One campaign. For $5, someone can buy a vaccine for someone in need in low-income countries. And it's not just about the dollars, though I believe in voting with one's wallet. It's also using businesses to put that opportunity in front of consumers and employees. And it's ensuring that the more of us who do that, we're using our voice to tell our elected representatives that we want them to do their part. So governments need to do more, but they report to us and we can tell them to do so.
And as you heard there from Anil Soni, the CEO of the WHO Foundation, just how crucial it is to have vaccine access for everyone around the world in the fight against COVID-19. Back to you, Jeff.
Tanya, thank you very much indeed for that. Let's have a look at the PMI series for France. We're actually waiting on the German data here as well, but the French number shows French services grew at the fastest rate in 5 months in November. The number came in at 57.4 points in November, up from 56.6 in October. The line that we're getting from IHS economist Joe Hayes, the service sector is what is keeping the economy afloat at the moment, as France's manufacturing sector is struggling with massive supply-related constraints. And of course, as you would have heard early on in the program, France has now, along with many other countries, revealed that it does have a number of the new Omicron cases. The German IHS market November final services PMI coming in at 52.7. The flash was 53.4. So that is just a little light on the flash expectation here. The expectation I had penciled in was for 53.4, in line with that flash number. But at this point, the German services companies posting only modest growth, and IHS suggesting that the Omicron story is now beginning to cloud the outlook in Germany as we wait on the new federal government to decide what new measures it may or may not impose at this point. Thank you, everybody, for being with us for the week here on Squawk Box. We're going to wrap it up. Thanks for tuning in. Street Science is coming up next.
This is not just a monumental story. It's a monumental business story. And that's because it will be corporations that create the vaccine that beats the pandemic. Is the market crazy? No, the